students. My name is Brenda. Welcome to our lesson of the day, and we are going to learn about partners or partnership accounts. This is our topic. Partnership accounts. And here, this is a business organization that is made of partners. Like two people have come together, two or more, three people also have come together to make a business or to do business together. So we call it partnership. So they have their books. So we have the income statement and the statement of profits and loss account. So I'm going to write the format. Of the income statement. So we call it XYZ partnership. Income statement. For the year ended let's say 31st December, the year is X. So we have our format over here. So we are going to write the format. So we will, just like the sole proprietorship, we will use the income statement, like the sales. We start with the sales, the cost of sales, then right from the gross profit is where the difference comes. So we write here our gross profit. Okay, then we have our expenses. Whereby we have the interest on capital charged on the partners. Say we have for X, Y, and Z. So this is their interest. This amount. So the interest on capital will be our expense here. Then we will have the salaries for the partners. Salaries. Then we will have all the other expenses, like the water bills, electricity bills, the postage, all the other expenses that we always include in sole proprietorship. We will just include them on our expenses in the partnership account. So from here, we will less the expenses. We get our net profit. Our net profit over here. Then this is our income statement. Then we will also have partners current account. That means our partners, they will be having some, maybe one made drawings. Then there is interest on capital. Then we have the salaries. Then the share of profit. Now we will rate our partners current account. Write the columns here. Then we will have our drawings. let's say the drawings for X was X shillings there. Then the drawings for Y, we also have the drawings for Y. And we will also have the interest on capital on the other side, on our credit side. Interest on capital. So we have for X, Y, and Z. Interest on capital, the other side. Then we will also have salary, then salary for the partners. Then we will have our share of profits. Share of profit. The amount every partner should get share of profit. So we will use our net profit. Let's say Y was to get 2% of the total profit, then X was to get 3%, then Z was to get 5%. Now we will put it here. Z 5%. X 2%. X 3% of X. So this will be our partner's current account. Now we will close our accounts there. Now this is the format of getting the partner's current account. So we are going to do a question, an illustration question from the partner's account. And I have a question here from November 2017, question number 3. It reads, Alex, Brian, and Charles are in a partnership, sharing profit and losses in the ratio 3:2:1, respectively. Their partnership agreement provides as follows. Charles is entitled to an annual salary of 2.7 million. Interest is to be charged on capital at a rate of 10% per annum. Alex and Brian guaranteed that the total income of Charles from the firm shall not be less than 15 million. Partners' trial balance we've been given. We have the capital accounts for Alex, Brian, and Charles. We also have current accounts for Alex, Brian, and Charles. We also have drawings for all the partners. Inventory, which is our opening inventory as at 30th June 2017. Then we have our gross profit. We are given premises at cost, motor vehicles at cost, equipment at cost, accumulative depreciation as at 1st July 2016, motor vehicles, equipment, rent, salaries and wages, water and electricity, office expenses, distribution expenses, bad debts, allowance for doubtful debts, accounts receivables and accounts payable, cash and bank balances. Then we also have additional information. Note 1, as at 30th June 2017, accrued distribution expenses amounted to 1.5 million, while rent paid in advance was 3 million. Depreciation is to be charged as follows. Note 2, motor vehicles 20% straight line method. Then equipment 10% reducing balance. Note 3, allowance for doubtful debts is to be increased to 5% of the accounts receivable. Required: A, income statement and appropriation account for the year ended 30th June 2017. Then we also have part B, partners' current accounts. We also have part C, statement of financial position as at 30th June 2017. Now, in our question here, so in our question here, we have all the we have our question, which we will do the calculations. We will do the calculations and we will follow this format over here. Now we are going to start with the gross profit, which we are given is 288,000. Let me note this zeros. So our gross profit will be 288,000. Okay. We will less our expenses. We less our expenses. We have some expenses here, so we have to find some space. Have to find some space here. Now we are ready to go. We have the expenses which we are lessing, and we have distribution expenses. Distribution expenses, which we have in our notes, and we are told accrued distribution expenses amounted to 1.5 million, while rent paid in advance was 3 million. Now we will find our workings. Not working one. We have our distribution expenses. Distribution expense, which was accrued to 1,500,000, and our rent was prepaid. Just like we know, accruals we always add, then prepayments we always deduct. Now, in our distribution expenses, it has already been added from what we had. So what we had 58,500, and now we have 1,500. Okay, so sorry for that. So we will take the accrued expenses, distribution expenses. We add we add what we have been given. So we will take 58,500, we add because it's an accrual, and we will get 60,000. Now our working one, we will have 60,000. We will have 60,000 as our distribution expense. We also have rent, and our rent prepaid, we are given 3,000,000. 3,000 there, I've omitted the zeros. 3,000 prepaid rent. Then we add what we have in the trial balance, 39,000. We had 39,000. So just like we said, repayments we deduct and accruals we add. Now we are going to less 39,000, 3,000 from 39,000. We will get 36,000. Now this 36,000 will be our rent. 36,000. Okay. Then we also have depreciation. Depreciation we've been given on motor vehicles. Depreciation on motor vehicle, which is working number 2. Depreciation motor vehicle, which is 20% straight line method. 20% of the cost. That means it's 20% of the cost, which is our cost is 60,000. So here we will get 12,000, which is our depreciation on motor vehicle. $12,000 will be our depreciation on motor vehicle. We will also have equipment, depreciation on equipment. Depreciation on equipment, which is 10%. 10% reducing balance. That means we will take the cost of the equipment. Cost of equipment is 90,000, and accumulated cost on equipment is 12,000. 90,000 less 12,000. Then we take 10% of this. We will get 8,100. So this will be our depreciation on equipment, 8,100. Then we will come here and take our allowance for doubtful debts, which is in note 3. Allowance for doubtful debts is to be increased to 5% of the accounts receivable. So our allowance will be 5% of the receivables. How many is our receivable? How much? Our receivable, we have 33,000. 5% of 33,000. So we will get our 5% of the accounts receivable. Then we take the the doubtful debts that we have been given. Allowance for doubtful debts 1350. So we take the allowance for doubtful debts and the allowance for doubtful debts that we've been given, then we less, and we will get we will less from 33,000. Sorry, we will take 33,000, which is our accounts receivable. We less the allowance for doubtful debts, 1650. Then we will get 31,350. 31,350. We will come and write it here, allowance for doubtful debts, 31,350. Now we will go ahead just a point of correction, increase. Okay, it will be our increase in allowance for doubtful debts. It will be an increase because the 5% has been provided, and yet we had another one, so we will add. So here we get our answer. And then we will take our salaries and wages for the partners, which we've been given 72,000. Salaries and wages for the partners, 72,000. Then we will also have water and electricity. Water and electricity at 9,900. We will also have office expenses at 12,000. We also have bad debts. They are also part of the expenses. Bad debts, which we have them at 3,000. We've been given 3,000 for the bad debts. Then we will make our total expenses, which is 21,300, which we will less our all expenses from the gross profit, and we will get our net profit, which is 74,700. This is our net profit. Our net profit 74,700. And now we have some other adjustments. We will have some other adjustments, like the interest on capital on all the partners. We are going to less. interest on capital, and we have note number 5. Okay, we have interest on capital of Alex, Brian and Charles. So for Alex is 9,000, for Brian is 6,000, for Charles is 3,000. Let's just confirm. Yes, we have our answer there. Then we are going to less the salaries. We are also going to less the salaries. Salaries for the partners. This is 18,000. We have the salaries for the partners, and only one of the partners gets to be paid salaries. And that is Charles, who gets a salary of, so we are going to take Charles, who is paid a salary, and we are going to take the profit which is available for the partners to share. We are going to take it and share the profit in the ratio 3:2:1. So we have salaries, that is for Charles. We are going to take our net profit, which is 7,700, and we are going to locate it to each and every partner. Now we have Alex salaries. We have for Alex, for Brian, and for Charles. So the salary for Alex, they are sharing in the ratio 3:2:1. Now we will take, for Alex it will be 3/6 multiplied by 74,700. We'll find our answer. Then 2/6 multiplied by 74,700. Then we will take for Charles 1/6 74,700. Now let's calculate the answers. For Alex will be 27,000. For Brian will be 18,000. Then for Charles will be 9,000. Let's just confirm. Let's confirm the salaries. Now we will put our salaries and the interest on capital. We will add them. We will get 54,000. Okay, we will get 54,000 here as our profit shared to the partners as salaries. Let's remove this here. We will get our profit shared to the partners. Now 700. We also have the toys. This one's 20. We'll also have these ones. 700. So our interest on capital and the salaries are shared, the share of profit, which is our salary, should be equal. So we should have the same salaries shared and the same interest on capital. So so this is what we should do on this question, on our question that we have. We also have the partner's current account. Partner's current account. Partner's current account. Sorry. Okay, partner's current account. And we have Alex, Brian, and Charles. So we will write the name of the partners here. Alex, Brian, and Charles. Alex, Brian, and Charles. So we will write their columns in that method. Then we will start with the drawings. Drawings on this side, and the drawings in which Brian took from the business is 22,320. And the drawings for Brian is 14,880. That is thousands. Then whatever Charles took was 6,000. Just run some few errors. 22,320 should be here. 14,880. Then we have 6,000. 6,000. Yeah, it should be there. This is drawings. Drawings, 6,000 for Charles. We also have balance brought down for Charles. That is money that Charles took from the business, but he had not paid it back in that year. Drawings, balance brought down. We have 1,500 right here. 1,500. We also have balance brought down on the other side. Create some space. balance brought down for Alex and Brian. That is 9,000 and 6,000. Balance brought down for Alex and Brian. We also have interest on capital on all the partners. Now the interest on capital will be on the credit side. Interest on capital, we write it here. And for Alex was 9,000, for Brian 6,000, and Charles 3,000. So for Alex was 9,000, 6,000 for Brian, then 3,000 for Charles. Okay? We also have salaries of the shared profit. The ones we wrote here. We have salaries of shared profit. Salaries of shared profit. For Alex, we have 27,000. 27,000. For Brian, we have 18,000. And for Charles, we have 9,000. Okay, those were their salaries. Yeah, then we will do our calculations. Right there. So we will have a balance carried down on this side. This side will be more, so we will have a balance carried down. So it will be 45,000 from the Alex side, then 30,000 from the Brian side, and Charles we will have 14,700. So we will come here, we write 45,000 for Alex. Okay, so our salary, which is our share of profit, we are going to add up the items. We are going to add up the amount, and we will get for Alex, we have just calculate yours. Alex will get 45,000 over there, and then Alex will get 45,000. Then Brian will get 30,000. 30,000 over there, and Charles will get 14,700. So these amounts should balance even to this side. Now what we are going to do, we are going to have our balance carried down. Have our balance carried down. We take 45,000, we less 22,320. Balance carried down. We will get our answer, which is 22,680 for Alex. Then for Brian, we will have 18,000. And for Charles, for Brian we will get 15,120. And for Charles it will be 7,200. Now the cost for the totals will be 4,700. Sorry, 47,000. Then 30,000 here, and 45,000. So that will close our partner's current account, and this is how basically it is done: the income statement and the partner's current account for the year ended 30th June 2017. And here we have the partnership: Alex, Brian, and Charles partnership. Yeah, so this will be our income statement and the partner's current account. So my students, thank you so much for attending the class. We will meet in our next class. Thank you.